Hey, we're apparently live. I am so sorry about this. Apparently, we've been talking and the Spanish internet connection just went. So I can only apologize. And hopefully, the people that might have been here, which there's now none. So I'm hoping that the people will rejoin and this hasn't been a total disaster. Um, so, yes, I can see that there's no one there. So I think hoping that you can all join me in a second. That would be good. If you're not, obviously, we'll answer the questions and we'll post them live to YouTube and LinkedIn, etc. So, good evening for the one person that has now persisted, I think is the word.
Excellent.
Yeah, I'm going to take an axe
Tenacious.
to the broadband connector straight after this. So thank you ever so much for joining us. What we will do is we'll go over to the questions and hopefully we'll get some people that come through. So for those people that have registered, good evening. We will get your questions answered. If you are not watching live, clearly you may still have questions. You can still type those in and we will get back to you at some point in time. So just be rest assured on that. I'm going to let Louise just answer this question if that's okay, which is the best. So this is from Aidan, who's asked best structure for a limited company partnership for flipping properties. So why don't you describe what a flip of a property is first of all?
Absolutely. So thanks, Aidan, for a lovely question. So we tend to talk about property income being generated typically from one of two key sources, either renting it out or buying something, perhaps doing it up or getting planning permission and then selling it on at a profit. And it's that latter that is often described as a flip, property flip. So you buy it and flip it almost immediate on purchase. So in terms of the best structure, the key thing to keep in your mind's eye is that when you flip a property, you're never renting it out. And therefore, it's going to be taxed if you do it in your personal name. It's going to be taxed under income tax rules. In a limited company, income tax and capital gains tax are at the same rate, currently corporation tax rate. So it really doesn't matter whether it is a flip or it's a rental income and you've then sold on the asset because the tax is the same value. And that brings me very neatly and nicely onto, well, actually, what is the best structure? So more often than not, for many of our clients who already have other forms of income in their personal name, it's best to do a flip inside a limited company. And that's actually for two reasons, one of which is tax and one is nothing to do with tax. Now, I'm going to start with the nothing to do with tax first, because to my mind, it's the one that's probably the most important and the one that probably tips the decision as to whether it is a limited company that's used. And that is all to do with risk. Typically, I see most clients when they do flips can be a little bit more involved perhaps than a rental activity. There's often a lot of renovation work to be done. There's a lot of activity to be done. And then, of course, you're looking for buyers. Those types of activities might be more inherently risky in terms of finding the right people, or indeed, having walls fall down around you when you're not expecting it. Note to self, don't give Simon a hammer on a wall that happens to be load bearing enough.
There is a broadband connection which is going to get the hammer.
I'm sure there is, but tends to be slightly more risky, and you'll pay much higher insurance as well on a flip. To make sure that obviously all the items are taken care of as need to be. As a consequence, most of our clients choose to keep that risk very neatly tied up in a limited company, because so long as you're not giving personal guarantees, then if something were to go wrong, and of course nobody wants anything to go wrong, but if it were, and perhaps you were to be sued, so to speak, it's not you being sued, it's your limited company. And I know that's a really negative way of looking at it. But in terms of protecting all the other assets that you've built up over time, all the blood, sweat and tears you've put into doing so, keeping something that is perhaps more risky than any other activity you're doing in your life as a separate legal entity and ring-fenced away from everything else is more often than not a really good thing. Now, the second key reason to do it is because, of course, if you already do have a fair amount of income in your personal name, let's say somewhere between £40,000 and £50,000, chances are when you sell the property, if it were in your personal name, you're going to pick up higher rate tax. Well, that's at 40%. Let's not forget, though, there's also national insurance, self-employment to pay on top of that. So you could be kissing goodbye to 51% of the profit you've made. Not great. Whereas in a limited company, it's perhaps going to be 20%, really, 19% currently, 25% if you hit the various bands that you need to for the new corporation tax rate that's coming in relatively soon. So do you want to pay 51% or 25% tax? And that's often a no-brainer answer. So for me, often a limited company is a great solution, but it's always horses for courses. You need to walk through your particular circumstances to really understand where it's best for you.
And that's a good answer to start with, isn't
Very
it?
good.
I guess the other issues that we won't go into tonight is around limited companies, whereby people open a limited company, close down the limited company to claim entrepreneurs relief, or what they now call business asset disposal relief, or BADA. Jinx. But you have to be careful of that because of TAR, which is it's not a colloquialism for thank you. What does TAR stand for?
Targeted Anti-Avoidance Rules. So you can find yourself on the sharp end of a 51% tax bill if you're not careful. If you repeatedly open, do the work and close businesses, pretty much doing the same or similar activity. And I use that phrase, same or similar, as a reflection on what the actual tax rules say, which is very ambiguous, very broad, very wide. It is what it is. I didn't write those rules, but you have to be very careful.
I've noticed that we're pretty bright on this screen tonight.
Well, it is Christmas time, shining bright.
Shiny bright with the sunshine. So that's some good questions on that one. Let's move over to Aidan's other question, which is VAT for commercial to residential. So why is it that people, first of all, whilst we're talking about this whole VAT commercial to residential, why is it a good idea to buy a commercial building like an office or a dentist? I'll talk about that in a second. Have you noticed that when you go past a dentist, it looks like a house? Go figure. It was most times. Why is it advantageous to buy a commercial building that you then convert into a home? What first tax do you pay?
Oh, well, the first tax you save a lot of money on is stamp duty land tax. SDLT, as it's often referred to, has two different rates: residential rates and, get ready, non-residential rates. Now, non-residential rates are a significantly lower value of SDLT than residential. So if you buy a property that falls into the category of non-residential, you're going to save yourself a lot of money on the SDLT to start with.
Absolutely. And then when you've got a commercial building, convert it to residential, typically what you have to watch out for on the commercial building, the downside to this is the fact that you've got potential VAT. So when a seller of a commercial building has a building, they could opt it to tax. I'm not going to get too technical, but opt to tax basically means that they may charge you VAT on the building. So £100,000 building, add 20% VAT, there's £20,000 VAT, £120,000. And typically what you have to also be careful of is that there's tax on tax. Why do I say tax on tax? Any idea?
Well, there's lots of ideas, but go on, share.
Okay. So tax on tax, what I mean by that is you have the VAT, which is 20%, but then you pay stamp duty land tax based on the total purchase value of a commercial building. So
including
you're buying,
the VAT.
Yeah, so the value of the building plus VAT. So it can be quite expensive from that side of things. So from that side of things, you've also then got to think about, well, if I'm converting from commercial to residential, can I get out of it? And you can use different forms to remove the VAT on that commercial building. You do need to get the approval from the seller to do that. Not everyone wants to do that. And why is that? Why don't sellers they're not willing to really cooperate?
Well, sometimes it's because they don't understand it, and people rightly and often fear what they don't know. So they don't want the extra hassle of having to sign forms that might tie them up to the VAT man in a way that they weren't expecting. There's also an issue that if you've, as the owner of the building that is selling it, if they've agreed to do a particular type of scheme, a VAT scheme, then if they sell the property within the first 10 years of starting that VAT scheme, they have to pay all the VAT reclaim that they secured right at the beginning of that VAT scheme back to HMRC. And most people don't want to do that because it's not small amounts of money that this particular scheme covers. So are they prepared to work with you and fill that form in and end up with a bigger VAT bill because they've got to do the reclaim? Or are they just going to sell that property to someone who doesn't ask difficult and enthralling questions to do with VAT?
Yeah, and most times people say don't understand it. So
No.
what they don't understand, they just kind of dismiss it. The other side to that is then when you're converting commercial to residential, you'll have building materials and you'll have labour. And if you're converting from commercial to residential, there are two types of VAT that you might need to consider. There's the 0% VAT item, which basically means that you're making a dwelling for the first time and then selling it. There is a possibility of reducing VAT from 20% on all building materials and labour from that 20 to 0. But if you're going to be renting out that said property, then it's going to be just 5%. I'm not sure why I was doing my hands like this, by the way. I just noticed I had to stop myself. So you would have a reduction of VAT, but there are so many upsides of doing a conversion of a commercial building into residential, but there are so many trip ups as well. So please do be careful. We've seen a lot of clients actually get that wrong, whereby they go for a 0% VAT scheme, but then they don't register with VAT. We just had one client where HMRC said no and refused the 0%, so they couldn't claim back the VAT because they was late with the registration. So that's a real shame. But you do need to act when you get the advice, and that's always a danger with anything like this, unfortunately.
When you are getting involved in this kind of activity, go talk to your tax advisor, because if you don't fill in forms, as Simon says, in a particular timescale in the process of buying, even before you've bought the asset, you might find yourself precluded from actually claiming some of those amazing reliefs that are out there. You just need to really make sure you understand every step of the journey way before you commit to buying, if you can.
It kind of sounds like a police record. Every step you take. Is that the wrong band?
Oh dear.
Yeah. Every step you take.
Sorry.
It's Christmas. Come on. Let's get the
That's not a Christmas
karaoke.
song.
Wow. It's festive. Talking of festive, Rob Alexander's on LinkedIn.
Is
live
he?
watching you. So
Excellent. Hello, Rob.
Yeah, he's going to be marking you out of 10.
Oh dear.
Don't mark me, Rob.
Well, feel free to.
11 isn't an option.
Awful.
Yeah.
No Eurovision Song Contest for them.
So moving on swiftly, Lewis has asked a question,
Lewis.
and Fayez has asked a question as well, both connected, which is, when should you use a limited company? And it's a great question. It's a question we get every week, if I'm totally honest, but it's one that we'll answer every week. Limited companies, why do people use it?
Because there is a perception sometimes that it is going to be more tax efficient than buying in your personal name. And sometimes it's because of non-tax reasons, for example, the risk mitigation and planning reason that I mentioned previously. So there are lots of reasons, but I'd say it jumps into those two buckets typically when clients come and talk to me about it.
Could I make a request? Could you now take off the hat?
Why?
Because when people watch this in March, enough said.
He's such a bar humbug.
I know.
No,
you have to. It's but we're not going to have a spat of marketing. Okay, I'm the marketing director. Come on, play the game.
5 more minutes.
5 more minutes. Right, I'm just going to sit here.
Sorry, team.
This is uncomfortable. Awkward.
So, Lewis, what's Lewis got to have to say?
Lewis,
Hello,
when
Lewis.
should you use limited company? It's the same question. What's the disadvantages, though, of using a limited company? We're talking about tax advantages of using a company because it's 19% corporation tax versus 45% income tax in your personal name. You have got to always extract money out of the company. So there's one particular client that we can't talk about. But there's no point using a limited company if you need all the money for lifestyle purposes. So if you kind of think, well, I actually want to live a lot, not live a little, but live a lot, and you want all the money, then actually using a limited company can make you pay more tax. Let's not forget that income tax on dividends goes up next tax year by 1.25%. So if you're at 7.5%, it's going to be 8.75%. I'm now going to throw myself off. 32.5%. Is that right? 32.5 goes
Yeah.
up to 33.75. Is that right?
Yeah.
Is that right? So, and then you've got corporation tax on that as well. So you could be in a position where you're paying 55% tax, depending on your income corporation tax as well, how much you earn. So you might be better off just keeping the properties in your own name or any business activities. And that's something that we will be visiting quite often throughout this year.
I think one of the other issues, I'm going to take my hat off now because we've had 5 whole extra minutes.
Yeah.
Anything to annoy poor Mr. Mishevich. I think the other reason that it can be a disadvantage is that sometimes it can feel like a sledgehammer cracking a nut. What do I mean by that? For some of our clients and individuals, they are just starting out. They're not making substantial amounts of money as yet. They may never want to make substantial amounts of money. They may just want it to tick over. And they perceive that obviously a tax rate of currently 19% corporation tax is perhaps better than where they are now, which might be at the 40 or 45%. And I understand that. But you need to look at the real numbers behind the scenes, because running a limited company, even if it makes no money a year, is going to cost you, I would say, somewhere between £2,500 and £5,000 a year before you even start to see anything happening. And that's because you've got to add up your bookkeeping software, perhaps bookkeeping services, accountancy fees, tax advisory fees, filing fees when it comes to things like confirmation statements, and all manner of other key points you need to be aware of. So if it's not saving you at least the same amount of money as it's costing you in a tax bill, why do it? Why get yourself involved in that kind of activity? And when you add on top of that the fact that, for example, mortgage rates in a company are currently more expensive than mortgage rates in your personal name, you really do need to look at the absolute values and numbers, not just at the tax rates, in my opinion.
Yeah. And I think that's a lot to be said about in terms of you've got the extra administration, dealing with accountants, dealing with Companies House, HMRC twice over.
More deadlines.
It's not just about tax and money, but it's also about administration and hassle with that as well. So it can be quite painful to use a limited company. You've got to be very careful.
In some circumstances, and we did this as a bit of a quiz a few years ago as a team, we worked out how many deadlines there could be if you're running particular kinds of payroll and VAT. And it added up to something like 57 deadlines a year to do with a limited company and particular filing deadlines of particular forms. So it can become quite an onerous administrative burden.
Yeah. Let's talk about another question, which I'm going to put on this chat box. Disasters of setting up a limited company. I've got to get this right, because if I don't, Lynette Co will be on top of me tomorrow to talk about how bad my grammar is. Setting up a disaster,
and she will.
Disaster, setting up a limited company. But there we go. So let's just talk about this for a second. There's a disaster setting up a limited company. Let's talk about some of the things that we've seen, actually, because we should spend a couple of minutes on this, because I know you can go to company formation, Companies 1, 2, 3, whatever they're called. You can even go to Companies House and set up a limited company. It's really, really cheap. But some of the disasters I see are shareholders, shareholder agreements. What kind of issues have you seen when you look at self-assessment tax returns?
In terms of the connection to limited company structuring? Do you
mean? So someone coming in with ordinary shares.
Okay. So most of the companies that can help you set up a limited company, they're fantastic, but they really need you to know what you're doing, and they need you to be aware of much of the law around the Companies Act, as well as the tax laws and legislation. And if you don't have a grounding in that kind of data, you're in danger of creating a company that actually doesn't do anything you want it to do and creates a huge onerous burden on you, never mind the tax, because of the mistakes that you've made in its construction and the way that the likes of Companies House might come after you to correct them.
I like what you did there, by the way.
Did I?
Yeah, because you said construction, which is property related. Well done. That's very good.
But one of the biggest issues that we see more often than not, and that we end up working with our clients pretty much from the get-go when they come to us with already a created company, is restructuring the shareholdings, because they're often designed in such a way that makes it very tax inefficient. and makes it inflexible. So there's no agility in the structure to allow you to develop your business tax efficiently, as well as plan how to involve perhaps third parties, other members of the family, or plan on how you might leave it as a legacy to those family members as well in a really structured and tax efficient way. So we often find that we have to do that work pretty early on. And if that business has been set up some time and it has inherent value in that business already as well, then it may be something that can't be fixed easily or cheaply, and it's likely to create massive tax issues for you there and then when we're trying to structure it. It will save you lots of tax, most likely. We wouldn't be suggesting if it wouldn't, but it's probably going to cost you some serious money to begin with to get it in the right structure.
But there's also issues with structures in regards to people having multiple companies. So we've seen accountants say to clients, well, you need a limited company per buy-to-let property.
It's what I call the Branson effect, the string of Richard Branson Virgin companies. You don't necessarily need that. We're very much an organisation and a team that wants to minimise the number of companies. Back to my point, limited company is going to cost you £2,500 to £5,000 a year. Do you really want 10 of them? If you don't need 10, that's going to cost you an awful lot of money to look after.
And back to administration, bookkeeping, deadlines, etc.
Yes.
The other side of that is kind of missed opportunities. So people often talk about, yes, ordinary share structures using ABC shares. What about freezer shares, growth shares?
And this is where the opportunities start to really present themselves, because there are ways in which you can encourage and structure a business to move almost to someone else's ownership when certain things happen. You can also have individuals come online, so to speak, into the business at a later point, again, when a particular activity or income is triggered, so that they start to share in that income as well. And there's lots of different ways that you can do it to make it really flexible and really very family oriented. So many of our clients talk about leaving a legacy and making sure that their families know how to take care of that legacy. And some of these structuring methodologies actually encourage and require those individuals to start to show their maturity and capability before they actually get anything out of those shares. So it's a great methodology as well of training up your family to take on the legacy when you're perhaps not wanting either to do it or sadly no longer here.
And one of the other disasters is not using freezer growth shares for inheritance tax purposes, which passes on that legacy without the 40% inheritance tax. But the other side to setting up a company in a real bad way is the fact that you've got adult children. So as an example, you might have a 20-year-old going to university. You're taking money out of the limited company in the most tax inefficient way possible, only to give it to your child to, have a nice lifestyle in the digs of the university, when actually you could have made them a shareholder and given them £2,000 worth of tax-free dividends, and they're likely to be on a lower tax band than you anyhow. So that's never going to leave me. You could be more tax efficient structure with using A, B, C, D, E, F share structures. We have seen some disasters of people thinking that having ordinary shares of one share each allows you to differentiate your dividends, and it can't, can it?
No. So you need to be very careful that if you're in the same share class as your other shareholders, then particularly if you're married to one another as shareholders, so it's a husband-wife example, business activity, then if you are both in the same share class, if one of you wishes to take dividends, then typically both of you need to take those dividends. And that's not always tax efficient. We see scenarios where perhaps one of the spouses is a higher or additional rate taxpayer and the other spouse has no tax position. Unless you're both taking out dividends, so the higher or additional rate taxpayer is now paying out massive amounts of money on tax for dividends, then the no rate taxpayer can't take any. So you've got to really think through that process very carefully, and that's where structuring your shares, for example, into different share classes, alongside shareholder agreements, looking at growth shares, looking at freezer shares, is going to pay, without making it sound like a pun to Simon's idea, pay dividends.
Yeah. And I think the other one to finalize this point is of disasters and setting up limited companies is setting something up which then you need money for. So if you then go to a mortgage company and say, I need lending, the structure you have in place may actually be refused. So we constantly work with clients to educate them on being tax efficient whilst being able to get money from the banks. So we spend a lot of time making sure that our clients are structured in the right way that enables both of these things to work.
And sometimes there's a balance to be had. So you can either be rigorously tax efficient, ruthless almost tax efficient, but get no lending, or vice versa.
Yeah, interesting enough. So Tiago Silva is his command. So good evening, Tiago.
Hi, Tiago.
Who said Mo helps me on that. I now need to learn how to change from A to B shares. And that's what we're here for, Tiago. So book those tax calls. And, you know, clients listening, it's great that you're listening to a live environment, but do make sure you utilize the tax advisors. That's what they're there for. And I can tell you now, there's plenty of availability to get back tax calls booked in with them. So make sure you do that as possible. We need to move on, but so this is another question. If you do have any questions, again, if you're watching live, type them in now. If you're not watching live, don't worry. You can still type them in now. I will get back to you within 1 or 2 days. A question from Lewis. I'm hoping this is going to work.
Hello, Lewis.
So Lewis has asked a question. Explain how donating business profits to charity is tax efficient.
Okay, so donations of charitable donations, that is, as long as it's to a UK registered charity, will be classified as a legitimate, if you like, tax reducing expense. So just like buying, I don't know, stationery, paying salaries for your staff, it's an item that will help basically reduce the amount of profit taxable. And that's broadly how it works. It works almost in the same way in your personal name, really. But every penny you give to a charity is going to help minimize the amount of your income exposed to tax. Happy days.
And if you put money into, there is a differentiation, isn't there? Because there's the limited company, which you get 100% of the tax relief.
Yes.
What happens if you make charity contributions in your own personal name?
So if you make charitable donations in your personal name, then you need to be mindful of what your tax position is going to be in the tax year that you make those charitable donations. Let's not forget, personal tax year runs from the 6th of April one year to the 5th of April the next. So if you know you're going to be a no-rate taxpayer, as in you've got no tax to pay on the income that you're earning, do not tick the gift aid box. The reason for that is that if you tick gift aid, it allows the charity, for want of a better phrase, to go knock on HMRC's door and say, oi, cough up, Louise has just ticked the gift aid box. That means I can take some of the tax that she's paid to you and I can have it as a charitable donation. If you haven't paid tax, HMRC have just taken that money out of their own pocket. And they don't seem to like that, surprisingly. So they then come and knock on your door to reimburse them. So don't tick gift aiding. If, however, you are a high rate taxpayer or an additional rate taxpayer, what it does is it actually extends the basic rate tax bracket and all other tax brackets that you're exposed to by the grossed up value of your charitable donation. So if you've paid £8 as an example to a charity, then it's actually grossed up to £10, and that £10 extends your basic rate tax bracket. So currently we're in the £50,270 basic rate tax bracket. It would take that bracket up to £50,280. In other words, more of your income is stuffed and squeezed into the lower tax brackets on your behalf. So it's helping save you money as well as giving a worthy cause some of your cash.
That's a good answer. Let's talk about another question, which is again, this is from Lewis. Talk about, again, I think it should be probably balancing on limited companies. Lewis is asking, I'm looking to partner with two separate sole traders. It doesn't matter if they're sole traders or not, to be honest. I think there are two individuals that you would be working with as a joint venture partnership. I mean, I've lost count of how many people, unfortunately, have fallen out, whether that's close friends,
family,
more family than friends. I've got
Yes,
to be honest.
I
It's
would
really
agree.
sad, and it's
Business
painful to
sometimes
see that.
brings out the best in us and sometimes the worst.
Yeah, and I think people have got to be. Look, guys, I've got to be honest. If you value your friendship and value your family, don't go into business with them necessarily.
So it's the husband and wife team.
Yeah, but there is. I think that look. I think there's a level of understanding that you and I have, and it works. But there's so many people it doesn't work with.
Absolutely.
So
Can be very
please do
hard.
be careful. Please do take your time. And I mean this sincerely. Just talk more regularly. Don't jump into the first deal and then want to do a joint venture partnership. Take your time. Okay, I can't stress that anymore because you could lose your friendship, you could lose your family members, and it won't be just the immediate friends and family. It could be
It
wider
can have
network
wider
as well.
ramifications, absolutely.
So, with that all said, let's talk about structure because there could be a sole trader, which we've already talked about. We've talked about risk, we talked about income tax issues by being a sole trader. There's LLPs.
Limited liability partnerships.
Yeah, what type of LLPs? Let's just quickly talk about that. What is an LLP?
So an LLP, limited liability partnership. There are 3 types of partnership available in law here in the UK, and I would say the LLP is perhaps the most belt and braces and all-encompassing type of partnership structure. It means that there is a little bit like a limited company, limited liability, so long as, again, you're not giving personal guarantees left, right, and centre. But it means that if something were sadly to go wrong in that business, then the partners in that business have a limited liability towards resolving that problem. I hope a problem never occurs, but that liability limitation really seems to give people comfort that they're actually doing something protected. The important thing about any partnership is actually if you are a flesh and blood human being as one of the partners in that business, any profit that is shared with you out of that partnership venture is actually taxed in your personal name. In other words, it's caught under income tax, not something like corporation tax. So for some, they don't see the benefit of a partnership because it's not saving you any tax. But the benefit doesn't lie in the tax treatment. The benefit lies back, as I said, into that liability structuring that protects all the members of that partnership carefully.
And I think once you take that into account, you then realise what an LLP is for. So solicitors and accountants typically use LLPs because they can manipulate the income profits share each year, to be honest. So LLPs have got a greater flexibility. Coming on to the legal structure. Obviously, you mentioned LLPs, about limited. Sorry, there's someone above us who just moves around.
It's not Santa.
It's not Santa. He's not coming in, but he does like to drag furniture. So the thing about that is you could have this legal company structure in place, but the first thing I would say that is just the entity. That is almost like a framework. Again, back to my point earlier, get a legal counsel involved, and that sounds quite intense, but it is essential. So make sure you work with a commercial solicitor to draw up a legal agreement between all the partners to say who is going to do what and when. Part of that agreement needs to be things like if you fall out, what happens to the business? How does each member buy each other out, whether that's a member in an LLP or a director and shareholder in a company? You've also got what happens in death. So if you die, your wife dies or your spouse dies, then who takes over those shares and investments and what can they buy it for? Because in some structures you might say, well, actually, if you die, I want to buy it back. I don't want your wife or your husband part of this business. So you need to think about that as well. Who is going to do what and when? What responsibilities do you all have? And I think these documentations, I've got to be honest with you, a lot of people they get all excited about all the fun stuff and buying properties and stuff like that. And then when they fall out, they go, right, what does your legal documentation say? And that would be my first question. And they say, well, we didn't really draw one up.
We had an agreement. We had an understanding.
Yeah, got an understanding. Yeah, got an understanding. And you've got to have an agreement at that point in time. But then you fall out, and then there's no agreement.
And or there's no common memory of what was agreed. That's the other one that we see a lot. So I thought we meant this. Well, I definitely didn't mean that. I meant this.
Yeah, exactly. So I do think you need to do that. But then there's the limited company, who's the shareholders, again, using ABC share structures. So this is quite complex. So I would say that if you're working with joint venture partners, again, honestly, just talk to them a lot more. Don't just jump ahead and go with a first deal and say, yes, let's do this. It's all exciting. Actually, you probably need to meet with each other when it's raining. Because
when it's
that
dark and dreary
when
and
it's
cold.
dark and dreary, because you're not excitable. I think people get carried away in life a little bit and then say, yeah, it's all honeymoon period, and then tomorrow comes and it's not. So do that. Take your time with this. Work with a conveyancing. Work with a commercial lawyer to draw up that agreement and spend time on it. If you get through that stage, which is painful, then it's to be. I think there is something there.
The reason I love working with a commercial solicitor, so go and find your local quality, reputable solicitor firm and ask to speak to a representative of their commercial department. And the reason I like working with such solicitors is it's a little bit, if you've ever worked with a solicitor to build a will, they ask really great questions to probe the underlying requirements that you have. So, sadly, when you pass, who are you going to send on your goods to, your chattels to, your life's work to? What happens if they've already gone? So who will you then pass it on to? But what happens if they've already gone? Who will you pass it on to? And it's that kind of probing quality question and question set that you'll also get out of a commercial solicitor. So they'll probably come up with more scenarios than you realised were out there, but they'll come up with pragmatic, realistic scenarios and help you think through more that are specific to your circumstances as well. So it isn't going to be a couple of quid. I know that. But my goodness, it could save you thousands, if not tens of thousands later in the process when you discover a disagreement and no one has a common understanding of how to deal with it.
And last, before we finish on this one point, is what happens when you make a loss? Because if you put £100,000 in to get the business started and you're making losses and then your creditors are asking for money, who puts more money in? Because you're not always anticipating making those losses. But a lot of businesses, 85% of businesses fail or struggle. And therefore, you do need to think about, well, if we struggle, who is going to back this up? Where do we get the money to do that? And which of the members is going to do that? So you do need to think about a lot of things when you're doing joint ventures. But good luck, Lewis. I hope it's not put a dampener on things, but I do want to stem the enthusiasm before a massive mistake comes along. Because trust us, we've seen it time and time again, where clients have gone through this process, brothers, sisters, falling out. I don't think it's worth it, in honesty. So here's a question. So that's from Faz. I think we've answered that one really, but I'm going to go over to someone who's asked about stamp duty. Here we go. So this is live.
Stamp duty. I love stamp duty.
So Mark's asked a question. In a buy-to-let scenario, is there a way to either avoid stamp duty and land tax or get it back? I don't think so. I mean, I think what you do need to think about is when you let to buy. But I think irrespective, you're buying a property, aren't you? So let to buy could be a residential home. But nevertheless, if you're going to be paying stamp duty and land tax, I think you do need to be a bit wary. The one thing I did notice on this was the shared ownership scheme, where you got this 25%, etc. And there's been a couple of cases actually whereby people have paid more stamp duty land tax on the let to buy or home ownership schemes. So you do need to be aware of the stepped transactions, which could cost you a lot more stamp duty and land tax than if you bought the property outright. So just be aware of those kind of schemes.
HMRC, under the stamp duty land tax laws, love what they call linked purchases or linked transactions. And what that simply means is that every time you acquire more of a particular property, they reassess the stamp duty land tax due based on that higher value. So you might find yourself tripping, for example, into a higher rate of stamp duty land tax just going over one of the thresholds when you buy or acquire the next part of that property, if indeed you're doing something like that. HMRC will then not just assess the extra portion that you've bought, but they'll look back across the entire purchase that you've made to that point. And actually, if more now falls at the higher rate than just the portion you've bought, I'm afraid they're going to come back to you and go, well, not only do we want the stamp duty land tax for the higher bit you've just bought, but actually we want you to top up for the whole of the value, because we now realise you underpaid for that prior part of the purchase. So it's quite nasty. There's no time limit either on stamp duty land tax linked transactions. In some types of law, it only looks back over X number of years. SDLT looks back for as long as they like, as much as they can get out of you, I'm afraid. So be very careful.
We have another question, which is from Mudge Trader.
Hello, Mudge Trader.
So what is the difference between the holding company and a trust?
Ooh,
huge, I think.
Lovely question. This could be setting an exam type question.
It could, couldn't it? To be honest, a trust is very much a used typically. Sorry, my leg is just cramping up. I've got straighten my leg. It is a legal framework really for protection typically. So a trust could be there for the beneficiary or for the benefit of someone that you want to be there, but they are not necessarily the legal owner. So it's a form of protection on that side. Where a holding company is an owner, a company, which is not an individual, but actually is the an entity that owns other companies, whether that's a buy to hold, a flip, a business, whatever. A holding company is the owner of all these businesses. So to be honest, it's really is comparing apples and pears because they are so fundamentally different, and the benefits of one versus the other. I would say it is better for you to say, or for us to ask you, what is it you're trying to achieve? Because it's almost looking at a toolbox to say, well, I've got a spanner, I've got a screwdriver. What's the best one? Well, actually, it doesn't. It's a moot question. It's more to do with what do you want to do? Because if you want to put a nail in the wall to hang a picture, then a screwdriver probably could work, but actually a hammer might be better. So I think really that can be quite confusing unless you've got anything to add on to that.
I don't think I'm going to be able to add very much other than to say that trusts and holding companies are very different beasts. They allow you to hold assets like properties. That's no problem. You might find more difficulty in getting certain types of mortgage, for example, if you want to hold an asset in a trust compared to a limited company. It's a more rare activity. But trusts are an amazing tool in your toolbox. But to Simon's point, just like a limited company, it's horses for courses. It really depends on your circumstances, what you're trying to do, over what period of time you're trying to do it, and how you want to go about taking any ownership from the income of that asset as well. Because trusts more often than not mean that you're giving an asset away, arguably to the trust, and you're never going to see it again, nor are you going to see any income from it either. So there's a lot to be involved here.
I'm going to go back because I think there's a bit more clarity from Mark Webster, who's asking about stamp duty land tax.
Oh, okay.
But is it the case that if you sell a property within 3 years, you can claim back the SDLT back?
Lovely clarification. That's fabulous.
So I think what we talk about here, the claiming back of property, no, you can't. The only type of SDLT you can reclaim is the 3% higher rate. So the 3% higher rate in this regard is whereby you've got a home and then you buy another home, but you do not sell the first home. So now you've got, technically speaking, a home and a buy-to-let. Okay, so since you haven't sold it, you now pay 3% on the home, the new home that you are going to be buying. Can you get that 3% back? Yes, you can. Typically, there is a piece of law that allows you to sell the first home within 3 years and then claim back the 3% SDLT high rate on the home that you've just purchased or within that 3-year period. But it's not the entirety of SDLT, hence the reason why we were saying you can't claim SDLT back, because there's different layers of SDLT. It's the 3% SDLT that I think you're referring to. Anything more to
No.
share with us?
There's lots of ways to minimise stamp duty land tax in the first instance. And on prior podcasts, we've talked about things like making sure you're fully familiar with the value of chattels and having them excluded, specifically captured in the documentation and then excluded from the SDLT calculation. So there's lots of things you can do to help minimise it for sure. And you might want to go back to some of those podcasts to look at what we said.
I'm going to go to a question. Again, this is someone who registered for the event some time ago. I'm just going to share this one. This is where it starts to take over our heads a little bit. But it says, Peter says, have a UK limited company, 2 directors, wife and me. We each pay 25k dividends, no wages drawn. I'm not sure why, but we'll talk about that shortly.
Sure.
Plan to retire in 12 months. So retirement, good. Congratulations. But want to draw as much possible from the income from the limited company to invest in property in my personal name, not in another SPV. And he goes on to say other forms of income. But I think on that point, I typically, and I'll let you kind of have your views on this, but I'm never keen on someone generating income from a limited company and then being taxed on it from a corporation tax perspective, taking as much money, like 150k. I mean, 150k, you're already an additional rate taxpayer, depending on your other forms of income, which is now 45% tax. Now, if you in today's money, you're paying 38.1% income tax on the dividends once you reach over £150,000. In addition to the 19% corporation tax. So if someone's buying a home, people typically, or a house to rent out, people typically talk about BMV, below market value. And I often say, well, is it really below market value if you're shelling out 38.1% income tax on that? It just doesn't make sense to me, if I'm totally honest with you. If you're thinking about retiring, then you might want to phase it over a period of time to take money out in the tax efficient way, and then maybe save it up in your own name if that's what you want to do. But I would get some real tax planning on that one, Peter, because I just think that you could be on a hiding to nothing.
And to your personal circumstances. I mean, we talk with our clients in particular about there being circa 9 different ways to take money out of a limited company, all with different tax implications. One of the best ways to take money out of a company, if you don't need it to reflect upon an SA 302, for example, in your personal name for mortgage purposes, is to take back any director's loans that you've already put in. That's just one of the 9 ways. Because, of course, if you're taking back capital that you invested into your company, then that comes out completely tax-free to both your company and to you. So if you're looking at your director's loan account, Peter, and you've got some cash there, that's going to be a no-brainer, in my opinion, of one of the first places you go to extract that money. And then go talk to your tax advisors, as Simon suggested, about the other ways to extract that money that you need.
Yeah, I think there's so many things that you can look at on that regard. Let's have a look at another question. This is from this time we have Ryan. Ryan asked if I was to purchase another property, this would push me over the 20% tax bracket as I am a sole trader. Instead of using a limited company structure, am I able to put monies over 50k into a SIP to reduce my tax back down to 20%? Let's talk about what SIP is.
Self-invested personal pension. So it's a type of pension scheme, and it pretty much does what it says on the tin, really. So it's self-invested. In other words, you control it. You don't have some fund manager looking after your money for you. You're deciding where you're going to invest it within certain limitations and boundaries. But you're making all those decisions, so you can decide how you use that money. But a pension scheme in general, can be a really tax efficient saving plan, for want of a better phrase, for later in life. And the question is a lovely question. So I'm thinking purchase another property probably means you're buying a rental property. But to a degree, it almost doesn't matter. It's about the fact that you're investing in some kind of business that's going to generate lots more money for you, and that's going to force you into the 40% tax bracket rather than what you're in currently, which is the 20% tax bracket. There are indeed ways to bring your income, as far as HMRC is concerned, back down to the basic rate tax bracket. And we talked about, funny enough, pensions just a few minutes ago, really. So for every £8 that you invest. So this was charitable donations, beg your pardon, but it's almost same treatment for pension contributions. So for every £8 you invest in a pension scheme, then actually you're going to extend your basic rate tax bracket by £10. And that's assuming the pension scheme isn't getting you what I call full rate tax relief. You're only getting basic rate tax relief. So most private pensions, like a SIP, will only secure for you the basic rate tax relief, and the rest you have to secure through your personal tax return. So that's another lovely way of not necessarily bringing your money, so to speak, below the 50k, 52, 70k limit, but it actually extends the amount of your income that's exposed just to the lower rates of tax. So I love that as a methodology alongside alongside charitable donations. There's other ways that you can actually extract, so to speak, and get refunds if necessary on any income tax you've paid. And that is looking at certain investments like, for example, EIS and SEIS. So EIS, Enterprise Initiative Scheme, and SEIS, Seed Enterprise Initiative Scheme. We wouldn't ever be able to advise on that kind of thing in terms of which schemes are the right ones. We're not FCA regulated, we're not wealth advisors. What we can tell you is the tax reliefs and the tax benefits. And those two lovely schemes give you basically income tax back. So there's lots of different ways you can make sure that if your income is taking you above what is normally the basic rate tax threshold, that you aren't then penalised for it at the 40% rate.
Great answer for that one. I'm going to move on quite quickly. I know I've purposely taken the name out, but the person that asked this question, you will know who you are because you'll be watching, I'm sure. But this is a question that we will talk about before the meeting started. And it says, bought a property in 2020, renovated it throughout, decided to sell due to post-COVID market house prices, made good profits, has sold the property. We want to invest further into next property. By any chance, is there a benefits of doing this within the same tax year? One of the source subjects, and this is the reason why I didn't want to bring the name, but you'll be listening in, is if you bought a property in 2020 and then you sold it pretty much within the year without renting the property out, then unfortunately it's a flip. And what consequences is that?
Well, back to what we said at the beginning, and to be fair, this individual may already understand this, but perhaps some others listening may not. But actually, if it was never rented out and you can't prove it was ever going to be rented out, I'm afraid it's classified under income tax and national insurance. So back to my 51% tax on your profits, rather than, for example, capital gains tax, which goes up to 28%. So you're paying out an awful lot more money, potentially, of that profit as tax if it's genuinely a flip. But having said all of that, it may be the very best solution. And if it's giving you a great outcome, even after tax, fantastic. Wanting to invest in the next property, is there any benefit of doing it within the same tax year? Sadly, most cases, no, there isn't. When it's a residential property, then I'm afraid the individual purchase and sale processes are completely independent of one another. A sale of a property under a flip is not going to help save you any cash from the rental income, for example, of a second property you bought with the proceeds.
I mean, there are certain rollover reliefs, but typically it's not for when you use it for businesses, or you've got holiday let, but as you mentioned, it's certainly not for residential. So I would say, person listening in, definitely get their tax call booked in with us. We can certainly help you with just to clarify a few points that I think would be relevant to you. And the tax advisors are free tomorrow, so book it tonight. And you'll get to speak to someone. There's a good question actually it's just come in from Naima, saying if I'm gifted a property legally via solicitors, yet they live in the property until they die, would I be able to get a mortgage on it in my own name, and would I have any tax implications?
Lovely question.
It's a great question. I think let's take this into two parts. Let's think about your parents first of all. What's happened here is that your parents have gifted you a property. In order, and my belief is that in order to
it might not be parents. It doesn't really matter what connection they are to. It's just
I'm not finished.
Anywho,
shall I get a cattle prod? Right.
Moving
okay,
on.
Here we are. So get you a bit of a shock there. So my view is that parents have given over a property, like say ungifted, but they want to live till die. I'm going to give that scenario. If that's the case, then if it is parents, you do have to be wary of this because it's a gift with
reservation of benefit.
Right? What is that?
A GW-ROB is basically a method of a HMRC ensuring that inheritance tax is paid on the death estate of the individual still living in the property as though it was their own. The fact that it has physically been gifted to you legally, sadly, doesn't mean it moves from an inheritance tax perspective. In fact, HMRC, you might argue, are going to get two goes at the bow when it comes to inheritance tax, because they'll take it from the individual who was living in the property up until death when they pass on, sadly. And then when you pass on, they're going to take it again, aren't they? How lovely. So there are certain ways that you can mitigate and prevent that gift with reservation of benefit impacting you. But you need to go talk to a tax advisor. One of the most simplest ways, of course, is that individual no longer lives in that property. A second methodology might be that they pay you market rate rent to live in that property, which of course is going to generate rent income for you, which you're going to be taxed on, I appreciate. But if you want to be sure the gift with reservation of benefit impact doesn't hit you, you need to be thinking about these things and getting on with them.
Well, the other issue that I kind of think about is if it is parents, and I appreciate you saying it's not, but typically it is in this scenario. If the person that is gifted the property is no longer the owner, they are renting it. There is this issue of, well, if the property is then sold and there's capital gains tax to pay, you pay capital gains tax. And if you're not living in that property, then you don't get private residency relief, which means you pay capital gains tax on the uplift in value from the moment that the property is being gifted to you and the sales price. So you could be faced with, you thought you was getting away from inheritance tax, which with some very clever ways you could, but you could not only fall into the inheritance tax issue, but you could also fall into the capital gains tax issue. The last point you raised about, could you get a mortgage on it? Absolutely. There's no immediate tax implications on you, to be honest. And you can get a mortgage, so there's no issues from my side on that.
The only downside, of course, with getting a mortgage is if you're trying to get it, for example, as a buy-to-let, but you're not taking any rental income for that property, a mortgage company may choose not to lend to you because they don't see it as a viable methodology of being certain that they should get their money on a regular basis. You might give them all the comfort and assurances that they will, but if they can't see money coming in for what ultimately is an investment asset, they may say no.
I'm going to just finish on...
Finish,
because we have literally covered off all the questions.
Amazing.
And it is already 10:05 Spain time, 9:05 UK time.
We're in Spain, people.
I wonder where we are. So I think we've covered off any questions on that, but I do want to probably tackle something that was interesting, and I thought we should just talk about this just briefly as we finish off tonight.
Sure.
And it's regards to a question that I saw from Google. So it's more to do with general questions that have been asked in the internet than it is your specific questions. But I thought it was very interesting. It's SAS pensions and inheritance tax. So most people watching this show will be property investors of some nature. And what you must understand is that buy-to-let property investments will be subject, I'm doing this thing with my hand again, will be subject to inheritance tax at 40%. And someone that has been working with me quite closely coined a phrase, and I really like it. It talks about when you write your will, did you make sure that you put in HMRC's claim of 40% of the assets? And I thought that was beautifully said, because actually you could be building up this wealth only to give HMRC 40%. You kind of think, well, why did I bother working so hard if that's what's going to happen? Now, pensions is a slightly different thing, because if you can invest into pensions, then pensions itself, when you die, is not subject to IHT, and that's because it's put into trust, technically speaking.
Yes.
So a pension like SAS can be very good. If you put money into a SAS pension or SIP or any other type of pension, it really is very powerful, because pensions, it's one of those things that people just don't invest into. And the reason for that is because they don't have immediate access to it.
Yeah.
And I get that.
And it's not necessarily been an area that's been well understood. It's not been very well written up about, albeit I would say more recently it's been fantastically written up about since SAS and SIPs came along. I think a lot of people really understand them a great deal better. But it is something that's quite hard to get your money back out of. In fact, it's impossible in many ways until, sadly, potentially you're no longer here. And it's then your beneficiaries who get the benefit out of it rather than you. And I think that probably does put a lot of people off. But it is a fantastic tax efficient tool.
We are going to finish, but if you found this really interesting, please do like it. Whether you're on Twitter, Facebook, LinkedIn, YouTube, just press a like, because it does help other people say if it's been useful, and also share it. And one very powerful thing I've seen myself do recently is I'll see a post on LinkedIn, wherever, and then I share it on my own profile, and I'll tag one or two specific people that I think will gain value from that. So what 1-2 people do you know would value this content, please? Because I think that's very, very powerful to share this amongst us, and then get them on the show next time around. It could save them a lot of tax. What a great present. It even comes with a bow. So thank you ever so much for joining us. We will be back on Wednesday, and I'm not sure what date, but it will be in January. So have a fantastic festive time.
Third Wednesday of January. See you next year.
You certainly will do. Thank you for joining us tonight, and I will look forward to seeing you again very soon. Good evening.
Good evening.